Welcome, everyone, and thank you, Nolan, for joining us.
Yeah, thanks for having me.
Before we kind of get Nolan going, I think I'll start off with giving a bit of an introduction on myself and introduce the thesis on Sandstorm, and then kind of get Nolan to kind of give us all the details. So my name is Bakar Sivia. I run White Falcon Capital. We are a long-only investment manager with a mandate to invest bottom-up and compound capital on a risk-adjusted basis. We align with our partners and charge no management fee, but only an incentive fee of 15% with a high watermark. I have about 15 years of investment experience, and before founding White Falcon, I worked at Burgundy Asset Management as a vice president and investment analyst, which is a global investment manager with $30 billion in AUM. The idea we are presenting today is Sandstorm Gold Royalties. The company happens to be in the precious metal sector, but I think investors can be agnostic to the price of gold and still find value in Sandstorm. We believe it's a high-quality company that has many levers of value creation and potential upside. Before we really get into the call, I'll just kind of briefly go through my thesis, because I know there will be people on the call that are not familiar with the company. So I'll kind of briefly talk about Sandstorm from my perspective, and then we'll get Nolan to talk about it a bit more. First, Sandstorm is a high-quality business that owns royalties and streams on 250 mines around the world, out of which 40 are currently cash flow generating for Sandstorm. We know that royalty companies are high-quality businesses that compound capital in good times and bad. Texas Pacific Land in oil and gas, Franco-Nevada in precious metals have been prominent examples. Second, Sandstorm has the highest growth profile amongst its peers. So its volumes should grow by 30% over the next 3 years. Third, Sandstorm is highly free cash flow generative and using all or most of its cash flow to pay down debt. Fourth, Sandstorm trades at a large discount compared to its peers, which themselves, I believe, are trading at the lower end of their historical trading ranges. Now, there are reasons for this, and we'll go through this in the call, but I think it's worth highlighting that you're getting a big kind of relative discount play here. So from a bottom-up perspective, even if gold prices remain at current levels, we believe investors have a potential 60% return from these levels on Sandstorm. And this is a combination of volume growth, debt pay down, and a normalization of multiples. Now, if you believe in gold like I do, and there are investors that are kind of across the spectrum on this, then an investment in Sandstorm has a lot of upside, right? And I believe royalty companies are one of the best ways to express an opinion on gold, and within these, Sandstorm has the best risk reward. So we'll talk about gold and the price of gold a little bit later in the call, but I think what I wanted to do was just explore Sandstorm as a bottom-up idea. Just even people that are agnostic to gold should find value here. So who better to explain the business than the CEO, Nolan Watson. Thanks again for joining us on this call. I think I'll just ask you some questions, but before we do kind of get into the Q&A, why don't you just briefly introduce yourself, introduce Sandstorm, tell us a bit more about the company.
Yeah, no, appreciate the background. So I guess a bit about me, which will lead into a bit about the company. I'm a business person by background, Bachelor of Commerce, CPA, have the geekiest award anyone can win in the world. I have a gold medal in accounting, first of 1,000 people when I wrote that exam. I did my CFA, but then immediately got into the mining business, fell in love with the mining business. So I've spent my whole career in mining. Fortunately for me, early on, I was working for a company called Gold Corp, which became one of the larger gold companies in the world until it got bought out by Newmont. And Gold Corp created a company called Silver Wheaton, which was the world's first ever streaming company. And I found myself in my mid-20s being a chief financial officer of that company. And we sort of built the streaming business model out as a team, and we grew that company from nothing to a multi-billion-dollar market cap over a period of a number of years. and it was really only being used in the silver space. And myself and my business partner, Dave Orem, who also worked at Silver Wheaton, we left that entity and we went and we started up Sandstorm Gold a number of years ago to be a gold streaming and royalty company. And so we've been building it up for there. So I've been in the streaming business model since it's existed on planet Earth, and have been effectively in it for about 19 years now.
Okay, and then tell us about Sandstorm, its founding, and kind of its brief history, and kind of where you are today as a company.
Yeah, so we started Sandstorm as just a shell company years ago, and we went out and we found mining companies that needed capital. And what we said to them was, hey, if we'll give you money to build your mine, if you give us the right to buy a certain percentage of your gold, or in some cases silver, for the rest of the life of the mine, and we'll buy it at an artificially low price. In some cases, the contracts we negotiated were $400 an ounce. So, for example, under those contracts, we're buying gold now at $400 an ounce, and we're selling gold the next day at $1,920 an ounce as of this morning. And so we're basically pre-purchasing the future rights to a certain percentage of all of their production for the entire life of the mine, including the exploration upside. And we get a massive margin on every single ounce. And so we went out when we started Sandstorm, negotiating these contracts with various companies. Now, when we started the company, we didn't have any money. I mean, I was wealthy because I had made money in past jobs. But we needed $50 million to get the company going, and we negotiated those contracts subject to financing. We went out and found the financing, and Sandstorm became a company, and then we've been iterating it ever since. We've grown, as you said, to we've got 250 streams and royalties on mines around the world, and like you said, 40 of them are operating, and we've got cash flow growing from over $100 million to, over the next few years, we should have free cash flow 4 years from now of $170 million per year at today's gold prices, which it's a pretty impressive company now. Yeah,
no, this is very interesting. But let's go back to the basics a little bit. I mean, you already explained how a stream works, but there are also royalties and there are also streams. I mean, some of the people on the call would be new to the sector. So can you talk about the kind of the basic differences between a royalty and a stream?
Yeah, so there are some important nuances. So a stream and a royalty, both of them are contracts, but the actual structure of the contract is different between a stream and a royalty. The tax treatment is often different between a stream and a royalty. I'll start with a royalty. A royalty is a little bit more simple. A royalty is typically a royalty is a percentage of the revenue of the mine for the life of the mine, period. So royalty contracts are typically 0.5% of the revenue, or 1% of the revenue, or sometimes you have a great royalty and it's 2% of the revenue. In one of our contracts, we have one that's 4% of the revenue of an awesome mine. And so the mine mines the mine, and at the end of every month, they go, what was the revenue from the product that the mine sold? And they multiply it by 0.04, and they cut us a check. Royalty contracts are considered in most jurisdictions part of the mine and mine ownership. So your contract and your royalty goes with the ownership of the mine by law, wherever that mine goes. A stream, on the other hand, is more of a contractual agreement to buy a certain percentage of the production of the life of the mine. And the stream percentages can vary over the life of the mine. Often what you'll see is something that says, like, we're going to buy 10% of your production for the next 10 years, and then we'll buy 5% of your production for the rest of the life of the mine. And when we buy it, we will pay, let's say, 20% of the spot price of gold. So for example, you sign this contract, and 5 years from now, the gold price goes to $3,000 an ounce. Every time that you're buying a contract or buying an ounce of gold every month, they sell it to you for 20% of the spot price. So if gold's $3,000 an ounce, I would cut them a check for $600 for that ounce, and I would turn around on the same day and I would sell that ounce for $3,000, and my profit would be $2,400. So you're basically pre-purchasing an 80% margin on everything that is produced by that mine for the entire life of the mine. Streams tend to be larger contracts than royalties. Like if you would say the average cash flow under the average stream cash flows more than the average royalties, because the royalties tend to be smaller percentages. One of the ways that we get streams versus royalties is actually quite different, and it's a nuance in our business model. Streams are typically a mining company goes to build a mine and they don't have enough money to build the mine. And so they need to either borrow money from a bank or they need to raise equity, but the equity capital markets aren't always there for them. Or often they come to us as streamers and say, hey, Sandstorm, will you write us a $100 million check to help us build the mine? And we will give you this contract for the rest of the life of the mine. Royalties, on the other hand, typically come about because junior exploration companies or exploration people, they have enough money to maybe do early stage staking, getting the legal rights to ground, kind of doing some rock chip sampling to see if there might be something there, or soil sampling to see if it might be a good candidate to be drilled to see if there's an ore body there. But they're often not very good at raising money, and they can't raise the funds to do the actual exploration. So what they do is they get the rights to the property, do a little bit of work, and then they knock on the door of a big company like Rio Tinto or Newmont or something like that. And they say, hey, I've got a property that looks like it's got a lot of stuff on it. We don't know. Why don't I give it to you? And you give me 2% of the revenue forever if you find anything. And so that prospector will get a royalty. And so the world is full of all these prospectors out there going out there and handing off their properties to bigger companies, but holding the royalty in case they're successful. And then when those companies are successful, companies like Sandstorm, we go out, we find that prospector, we buy the royalty from them, and we collect them. And so we've got this collection of royalties and streams in a portfolio.
Interesting. So if I understand you correctly, you have a contract on a mine, and if the ownership changes, that doesn't change anything for you. The new owners come in and then they start paying you. Or if
exactly, the contract's always tied to the mine, and we'll actually get a mortgage charge against the mine. The same way a bank has a mortgage on your house, we have a mortgage on the mine.
And if somebody abandons the mine but some new technology comes in, and a new owner comes in with that new technology, starts producing again, they also then start paying the royalties as the previous owners were.
Yeah, it continues in perpetuity. Right. Exactly.
So advancements in technology, essentially help royalty companies.
To a certain extent, I would say that one of the ways that Sandstorm has constructed its portfolio more so than its peers is I'm a really, really big believer that there are economic cycles that we can't control. The price of, let's say we've got a gold stream, but it's a copper mine. So you've got a copper mine and we're buying the gold from it. And the price of copper is going to go up, it's going to go down, depending on what the economy is doing. We can't really control that. And what we want to avoid is doing deals on mines where the cost of producing at that mine is high, so that if the copper price comes down and the mine starts losing money, they shut the mine down, we stop receiving our gold until either, like you said, there's a technological improvement or the economic cycle goes back up. We'd like to avoid those situations entirely. So the vast majority of Sandstorm's future production, over 60% of it is coming from mines that produce their primary product in the lowest cost quartile. So these are the lowest cost mines in the world that 75% of all of their mines are going to shut off before those mines shut off. And some of our competitors will have their mines shut off before ours shut off. And so ours won't shut off. It's this big, long, stable, durable source of cash flow. So the technological improvements are not really that important to us in terms of turning back on mines, because we've picked a portfolio of mines that aren't going to turn off in the first place for the most part.
Right.
Where technological improvements are useful is if they can find economic ways to mine marginal ore. So you've got this known ore in a mine that you're like, yeah, there's gold in that rock, but we might not make any money mining it, so we're not going to try. We're going to focus over here where we know the grades are high, and we're going to make our money over here. Sometimes if there's a technological improvement, you can go, well, that's economic too, and they'll mine it too, and then we'll get our percent of the stream of royalty.
Right. Super interesting. Now, how do you go about building this portfolio? How do you go about underwriting these deals? How do you evaluate these projects? How do you underwrite IRRs on these kind of royalties and streams that you do?
Yeah, it starts with the construction of the team and then the way we think as a team. If you think about Sandstorm, yes, we're a public company, so we have to have things like accountants and receptionists for an office and that type of stuff. But the vast majority of our employees and almost all of our compensation is tied up in a combination of our corporate development team and our technical team. So we have a group of really highly experienced, either ex-bankers or research analysts from the mining industry who are out there scouring the world looking for mining companies that have good projects that need money. And they are sort of our corporate development leads. And then separately, we have a team of scientists, some of the world's best geologists and engineers, literally the head of our technical team. We went on a hunt to find the world's best person, and we found the man running the metals and mining and petroleum department for the sister entity to the World Bank at the International Finance Corporation. Masters in mining engineering, math, and masters in geology, and was regarded as one of the best mining scientists, if not the best in the world. And we hired and paid him millions of dollars to come work for us, and moved him from Washington, D.C. to Sandstorm. And so he heads up our technical team, and we've hired a bunch of other scientists around him. And so our corporate development team is working with that scientific team. And every time our corporate development guys find something that they're like, hey, we think this is good, they go to our technical team and say, start your due diligence and working up to see if it makes sense for us to start negotiating deals. And then we'll approach companies and see if there is a deal to be done where we think we're going to get a high rate of return. Now, the key to, you're asking about like IRRs and those types of things. One of the keys of success for us to get a high rate of return, because we're obviously seeking, greater than 10% rates of returns in these transactions. The key to finding the ability to do that is finding mines that have above average exploration potential. And so you might have a mine that has a 7-year mine life on paper, but it's only 7 years because drilling is expensive and the ore body goes deeper, and the mining company is not, it's a one asset mining company and they're not making any money yet, and they don't want to put the drill holes deeper until they're actually already underground. So it's cheaper to do it from it. And your geologists are going, the mine's probably going to run for 30 years. We have no reason to believe it doesn't go past 7 years. We just don't have the drill evidence yet. And so you can strike deals paying for 7 years of production, and then you get 30. And that's where our IRRs really go through. Right. So that correspondingly, you could find a mine, and we see our competitors do this, and I shake my head all the time, but you can find a mine that's sort of just sitting at surface, and you drilled it, there's no ore past the bottom, there's no ore past the sides, you know exactly what it is. It might be a 12-year mine life. There's not year 13, because there's no ore on either sides or front and back. There's no ore below. That's it. You get what you get. And if you pay for 12 years of production, all you're going to get is 12 years of production. And those types of things just really don't interest us. So we've actually gone 6 years in a row now where the number of ounces that we have in reserves is the same at the end of the year or higher than what it was at the beginning, despite the fact that we cash flowed enormous amounts during the year from the production, because they produced and then they replaced their reserves. And so we have as many or more ounces on the books at the end of the year than we did at the beginning of the year, and that's excluding acquisitions. So any acquisitions are accretive to that.
Right. No, that's really interesting. And, and again, unlike a mining company, as you said, this is a business with a few business development executives, a few technical people. So from an OpEx perspective, royalty companies and Sandstorm, can make very high margins because, again, you're buying for 400, 500, selling for 2,000, and then the OpEx is not very high either.
Yeah, exactly.
Okay. Can you talk about a deal, maybe a specific deal, something that you have in the portfolio today that, that kind of worked out really well, and maybe a deal that did not work out really well for Sandstorm, and kind of what were the big learnings there?
Yeah, we've had a lot of deals that have worked out really, really well. We've only had one deal that worked out poorly, and it was the most valuable lesson I've learned in my career. And fortunately for me, it happened at the very beginning of the creation of Sandstorm, so we were able to self-adjust. And
sometimes that's a good thing, yeah.
Yeah, absolutely. I'll start with the bad one, and then I'll go to a good one or two. So the bad one was when we first started Sandstorm. I'm a big believer that the money that you're spending is shareholders' money to run the company. and that you should be very, very frugal. And so we were incredibly frugal at the beginning of the company. Before we had $100 million market cap, I took $0 in salary because I was like, I don't want to start draining the company's capital until we make it to a substantial size, and they can, paying me is not a big deal. We were subleasing the backroom offices of some other place and sharing offices, and it was all just and so when we would go to do due diligence, we didn't want to hire a team of scientists because scientists are really expensive to hire, and we didn't want this big G&A burden that was going to take the company down. And so we would hire consulting firms for due diligence, and we ended up investing in a mine in Brazil that the consultants we hired were just terrible consultants, and they missed all the risk issues, and we lost all of the money of that particular investment. And it was after that I went to the board and I said, okay, I know I've made a mistake being too frugal. I'm going to stay frugal generally, but I'm going to go the exact opposite way with our technical team and scientists. I want the best scientists in the world, and I don't care if they cost tons of money because they're going to be worth their weight in gold. And that's when we literally went on a hunt and found a guy and, paid him in very large amounts of money to come build out his own scientific team within Sandstorm. And that team is the most expensive part of running Sandstorm to this day, but boy, are they worth their weight in gold. And that happened 11 years ago. And since we've hired that team, we haven't bought a single thing that we've lost material amounts of money on in 11 years. And we've made a lot of money on a lot of deals. You compare that to some deals we've done. We've got some slides in our presentation that show how much we invested and how much money we've already pulled out and how much money the residual asset is worth on a present value basis. But I think one of the best deals we did, we spent $14 million buying a portfolio of royalties from Teck a number of years ago. We've already sold a couple of those royalties for more than the entire $14 million. And the royalties that we're still holding are probably worth $70 or $80 million. So turn 14 million into 100 million. We did a deal once where we gave a company about $35 million for the deal. And it was a 7-year mine life. We have pulled out already about $100 million from that deal. And the mine now has a 20-year mine life, and it's still operating, and we're still making money. And we have a whole number of other transactions like that.
Yeah, and and that's the thing about a royalty portfolio, with 250 assets on the books, where you never know, where the option value is on any of these assets, right? I mean, unlike a mining company which has 1, 2, 3 assets, and kind of a strike at a mine or an environmental issue at a mine can really affect profits and revenue. With this, you're so diversified across mines, across jurisdictions, across partners, that I think all the diversification kind of probably helps you kind of maintain profitability across the cycle.
Well, absolutely. I mean, the way I think about the streaming and royalty business model is, like, if you take a step back, there are a lot of people that the reason you invest in mining is usually one of two reasons. Either you really believe that particular commodity you're investing in is going to go up, like you're a gold bug and you think the gold price is going to go up, or you think there's exploration upside, right? I'm investing in this company because the market's assuming the mine is going to run for 8 years and stop. And I talked to the geologist and I know it's going to run for 20 years and it's worth more. And it's either one or other, or a combination of the two, that you invest in a mining company.
Right.
The problem with mining companies is that there are so many things that can go wrong in running a mine, right? You can have political unrest, you can have social unrest. I mean, the number of times that locals block roads and shut mines down. I have friends that, I run in the mining industry. A bunch of my closest personal friends are CEOs of mines, and I'll be sitting there having a beer with one of them while the road is being blockaded to their mine, and they're like almost crying. It's just, there's nothing they can do, because what happens is you can't lay off all of your staff and shut your mill down. You've got to be operational ready until that blockade is going. So you're still operating with about 80% of your costs,
right,
and 0% of your revenue. And so you're bleeding capital. And so, but then there are fires, there are floods. I mean, the number of times that we've seen mines flooded out that stops production for 2 months until you can pump out the pit or you can pump out the underground. And,
Right.
and during those periods of time, your revenue goes to zero and your costs stay what they are. And so, a mining company, if you're thinking like this was going to be my cash flow on a monthly basis every month for 12 months, your cash flow goes like this, then negative, negative,
Right.
and this. And the
Right.
actual average is much smaller than what you thought you were going to get. In a streaming and royalty company, we either get the ounces or we don't get the ounces. There's never a negative,
Right.
ever.
Yeah.
So we have this portfolio of things where some are doing this and some are doing this, but the portfolio just keeps doing this.
Yeah.
And it's just so much more stable. We have all the reasons to buy a mining company, including the price upside. Gold prices go up, we make more money. The exploration upside, if they find more ounces, we get more ounces. And almost none of the downsides that are so commonplace in mining. And so if you track the GDX or a basket of mining companies' performance over a 10-year period relative to a basket of royalty companies, you will never find a 10-year period where mining companies have outperformed royalty and streaming
Right.
companies ever.
Yeah. Yeah. And we saw that over the last 10 years. Yeah.
Yeah.
So Sandstorm itself, is a much different company today than it was 2 years ago. I mean, you've essentially transformed the company by doing 2 acquisitions last year, Nomad and BaseCore, and you essentially made Sandstorm into a mid-cap company from kind of a small cap company, and diversified the portfolio and kind of up the quality of the assets. But that's also led to some issues, right? Kind of new shareholders, debt, et cetera. So I think it would be interesting for the viewers to just kind of, if you could talk about how the company has changed over the last year and a half, and kind of what the complications were with that change.
Yeah, so about a year ago, we acquired 2 of our competitors, and the ones that we acquired were ones of very long life assets, very low cost operations. And in about 40% of the value that we acquired is in things that are being built now. So mines that are in construction now on, multi-generational mines. So what we did is we bought the future of Sandstorm and we bought our growth last year. It was $1 billion worth of transactions. The way we paid for it was a combination of equity and debt. And some of the equity that we issued went out to general shareholders and shareholders of those companies. We bought some of them, the little guys, retail shareholders, sold their shares quickly. And so we had a little bit of share price pressure when we announced the transactions. There always is a bit of merger arb stuff when you're taking over a public company. And then some of the competitors that we bought had strategic shareholders. So for example, Glencore, which is one of the world's largest mining companies, was a shareholder of BaseCore. They owned 50% of them, and they received some Sandstorm shares in the transaction. And Yamana, which had recently got bought out by Pan American, was a large gold mining company, and they were a strategic shareholder of Nomad, Nomad being the other company we bought. So we bought BaseCore and Nomad, each had strategic shareholders. Each strategic shareholder received shares of Sandstorm. And just over the last 3 months, 2 of those strategic shareholders, who are not natural long-term shareholders of Sandstorm, there's no reason why a base metal mining company out of Switzerland would own Sandstorm shares, sold their Sandstorm shares. So we've absorbed $100 million worth of net selling pressure in the market just over the last 3 months when volumes are pretty low. So our share price has really been under pressure from that. Those blocks have now finally and fully cleared the market. So that's done. And I think the share price is really ready to spring back. The other part of the transaction that we paid for was with debt. And so we, between the debt that we took on, plus debt that Nomad had when we bought them, that Nomad owed $150 million. So our debt that we took on to buy them, plus their debt equaled about $625 million, which is quite a bit of debt. And so we've basically just for the last year been stocking down all cash flow available to us to take that debt down. So we've got it down. I checked our numbers just this morning. We've got it down to $460 million US from 625. So it's come down massively. And what we're telling our shareholders is with interest rates as high as they are, like interest rates are very high right now. We just want to use all of our available cash flow to buy down debt, maybe buy back a few shares. And so we're doing that. So 3.5 years from now, our expectation is that Sandstorm will be a totally debt-free company. And all of our cash flow will be available for either growth or returning to shareholders at that point. And also turns out at that point, a bunch of the things that we just bought turn on, the mines turn on. And so 3.5 years from now, you go, okay, Sandstorm will be a debt-free company and their production will be 30% higher. Their free cash flow will be $170 million a year US, and it's kind of off to the races, and it's an incredible company. So we're in this transition period right now, and it's a really exciting future.
Yeah. So from a capital allocation perspective for the next 3 years, what you're saying is all kind of free cash flow will go into debt repayment.
Yeah, most of it. That's the plan. If we find an unbelievable acquisition and we're like, hey, we'll pause the debt repayment to buy this thing, we'll consider it. But we're being super, super picky because of where interest rates are. It's really hard to argue with, saving interest where interest rates are right now. So debt repayment is definitely the plan. One thing that people miss is we have a portfolio of loans that we have made to other mining companies. So sometimes when we went out and bought a stream, we'll be like, here's $100 million, and we'll give you a $20 million convertible debenture or loan to top you up so that you don't need to talk to the banks who are trying to compete with us to prevent you from doing a deal with us. And so we've got this portfolio of loans that is yielding us about 6 to 7% interest on a base when you compare it to the present value of the book value on our books. And that's about $240 million. So even though we have $460 million of debt where we've got interest going out, we've got interest coming in from a portfolio of $240 million for things that offsets quite a bit of that.
Okay. No, that sounds pretty good. And over the next few years, how do you expect the industry to evolve? I mean, so far, we see kind of Franco, Wheaton, Royal Gold as kind of the larger companies, and there has been a bit of M&A, so there has been a bit of consolidation where you've bought Nomad and Basecore, and Triple Flag has bought Mavericks. How does this, does that mean competition is higher, competition is lower, the industry is more disciplined? I mean, just maybe talk about the industry itself and how competitive is it at this point in time?
Yeah, there was a while there where it was very competitive. But I think that a combination of Osisko, Sandstorm, and Triple Flag have all matured our businesses respectively. Like we've all really improved our businesses over the last few years, and I think we're all pretty happy with our businesses. We each feel like Sandstorm, we don't feel the need to be aggressive on pricing and on buying anything new. And we feel our competitors sort of feel that way as well. Again, when you take out Basecore is gone and they're not a competitor anymore, Nomad's gone, they're not a competitor, Maverick's gone, they're not a competitor. There really is no material company below the size of Sandstorm until you get down into like tiny little companies like $200 million market cap things. And so I think the level of discipline we're seeing behind the scenes by the six of us is much higher. Competition is a little bit lower. In terms of, to answer your question of where do I see it going, I do think that there will be a little bit more consolidation. It's really hard to pick and understand exactly because there's so many social issues and market pricing issues, which companies will consolidate. But I definitely think over the next 5 years, you're going to see 6 companies turn into 4 or 5.
Right. Okay. No, that's very helpful. Now, we have a question from one of the audience members, and he's asking, can you keep the gold that you get from these streams, or do you sell it right away?
Absolutely. In fact, on our balance sheet, it's not unusual over quarter end to see a little bit of gold there in inventory. Sometimes that's because if the gold price dropped a lot right before quarter end, most companies are tempted to sell it so they can jack up their earnings, like show the most gold sold, and we're more methodical about the business, and we'll go, no, I don't like the gold price today, and I'm pretty sure it's going to be higher next month, and we'll hold gold sometimes.
Okay. Okay, very helpful. And the other question is, is just in the price of gold and kind of what that does to a lot of the mines that are not economical right now. And just how much of your portfolio would be economical if gold prices were to go to $2,500, $3,000. But maybe before we get to that answer, maybe let's talk about gold. I know you're on the board of the of the Gold Council.
Yeah, the World Gold Council. Yeah.
So maybe I can talk about from an investor's perspective, kind of my reasons for owning gold and owning Sandstorm as a proxy for gold, and then you can kind of talk about from your perspective, your view on gold, from here. So from my perspective, I'm a bottom-up stock picker, and for me, the basic reason why I own gold is because there's a lot of macroeconomic uncertainty, right? I mean, we used to talk about, millions, and now we talk billions and trillions, and nobody flinches an eyelid, right? Deficits here, deficits there, dollar, printing like no tomorrow. A lot of my value investing friends would hold cash, right? And, they say, this is what we use, in case something happens. And cash, fiat is being debased every day, right? So the way I think about gold is essentially a zero coupon bond in its own currency controlled by nobody. So essentially, you can buy US dollars, or you can buy Canadian dollars, or euros or yen, or you could buy gold, right? And in US dollars, you would get a yield, but you would also get a central bank that is going to keep printing. You would get a government that's going to keep running deficits. With gold, you get no control. It's an outside the system asset. And then you get supply increases at about 1.5% to 2% a year, right? So that's kind of the basic reason why I like gold. I mean, if real rates are declining, if the dollar is declining, then gold should do really, really well, right? And to my surprise, real rates have been increasing and are very, very high right now, but gold is flirting with all-time highs, right? And I think
that's very, very telling.
That's very telling, right? I mean, so now imagine that real rates start declining, dollar starts declining, and gold starting from here, I think has a lot of upside. But again, I'm not, I'm not an end of the world gold bug investor. I'm just saying, I don't understand everything that's going on, this QE, QT, all of that stuff. I'm a bottom-up stock picker. Can I have an asset that I can allocate 10, 15% of the portfolio to that can be a diversifier for my 85% kind of long-only equity portfolio? And, as you go, historically, as you kind of look at different periods where, inflation was high, real rates were low, dollar was declining, you see that gold and gold equities act as a really good hedge to a bottom-up equity portfolio. And kind of that's my reasoning for kind of being in the sector. And why not just own gold, right? And I do own some gold personally, physical gold, but from a portfolio perspective, I also want some yield, right? And Sandstorm is a dividend-paying company. So with Sandstorm, or a royalty company, I can hold gold, get a dividend yield, and get optionality. So that's kind of why I own it. But let's kind of hear your perspective, because I think you're probably closer to it than I am.
Yeah, I think one of the benefits of being on the World Gold Council is I get to see a lot of what's actually happening around the world behind the scenes, and getting data at the central bank levels. And we actually have a division within the World Gold Council that sits down with central bankers and talks to them. And so we get a really good feel for what's going on. It's very, very clear to me, more so than at any other point in my lifetime, and perhaps ever, at least in modern history, that central bankers around the world are trying to find ways to build a world financial system that is not solely based on the US dollar. Because historically, the US has, and it's been fantastic for the US, the US has built a financial system, including payment rails in the US dollar, where people will put their foreign currency reserves in US dollars, or countries will, And then if you fall afoul of the US and you don't do exactly what they say and they put sanctions on you, they have the right to freeze your foreign currency reserves. So as a country, you're saving in US dollars, then you can lose your savings if you piss off the US. And, that's fine if you're Canada. We're going to have a great relationship. We're not worried about the US ever freezing our foreign currency reserves, but it's not great if you're Brazil or if you're China or if you're Russia, for example, which just had all their US foreign currency reserves, or if you're Belarus or any of these other countries. And there's about half the world who is not really wanting to take that risk anymore. And we're starting to see those central banks decrease their exposure to the US dollar and buy gold.
Right.
And when that happens, it's going to put a long term, if this continues for the next 20 years, it's going to put continuous downward pressure on the value of the US dollar, and it's going to put continuous upward pressure on the price of gold. So I'm fundamentally bullish on gold for the very long term. The gold tends to, on average throughout history, go up with inflation because it's not being printed the way fiat currencies are being printed. But I think we're going to see gold go up with inflation plus up with this fundamental buying central bank demand for the next couple of decades. And so I think you would go, gold is a smart asset class to have in your portfolio because it's got fundamental reasons why it should do well. But then you layer in the fact that gold on a day-to-day, week-to-week, month-to-month basis typically trades inversely related to everything else that's in your portfolio. So it gives you a better risk-adjusted rate of return on a portfolio basis. A lot of really smart portfolio managers use it that way. But then you go, okay, if you made the decision to put gold in your portfolio, why would you not, instead of just owning a bar of gold that's just going to trade based on the price of gold, why would you not buy through a streamer gold in the ground where there's actually the right to have the exploration upside if other gold is found? Right. So I'm buying this 1 ounce and I'm paying for it on a present value basis for what it's worth on the day that it's going to come out of the ground. But that 1 ounce might turn into 3 ounces.
Yeah.
And so you get this much, much higher yield, but still in a safe investment vehicle. So, I do think gold should be in portfolios, but goodness, if you're going to put gold in your portfolios, I don't know why you wouldn't just go and pick 3 streaming and royalty companies and just, divide your gold allocation to the 3 of them and just, you will outperform the price of gold.
Which is exactly what I do. So I own 3 in total.
There you go.
including Sandstorm. So the question that comes from that is, somebody's asking, so if gold prices do go up, say they're kind of $2,500, an ounce, what does that mean for your portfolio, for your cash flows, and for the optionality that you have in the portfolio?
Yeah, it's a great question. So if gold goes to $2,500 an ounce, obviously we'll get a 25% increase in our revenue and cash flow. So that's fantastic. But like you said, we had 250 streams and royalties, 40 of them are producing. That means 210 of them are not. And so when commodity prices are high, investment dollars into those 210 that are not start increasing. If it's a development asset, it's more likely to get developed and turned on. If it's an exploration asset, it's more likely to have exploration dollars put into it. And so all of this other stuff in our portfolio that currently has no value, I mean, everyone's just valuing this based on our current cash flow and our expected future cash flow. All of a sudden, you start having mines turning on. And so, when I said we're going to have $170 million a year of free cash flow at today's gold prices, that 170 goes to, whatever the number is, 220, 230 million. And then all of a sudden you get these surprises and other mines start turning on. And so 230 goes to 240, 250, 260. And so we do have a lot of upside optionality that way.
Right. Interesting. We have another question, and it's just about the discount that you trade to your peers. So what do you think the discount is currently, and kind of, maybe I'll add on to it, how and when would you expect it to close?
Yeah, so I'd say our closest peers in the mid-cap space are Triple Flag and Osisko. And if you go back just over a year ago, we were trading at a higher premium in the market, a higher price to NAV multiple than either of them. So our NAV multiple was higher than both Triple Flag and Osisko. And then we made those acquisitions. We issued all of those shares, and those shares have just been hitting the market and like pounding our share price down relentlessly over the last year. I think most of that is done. And I've noticed over the last month, if you kind of go back and just analyze last month, we've started to outperform Triple Flag and Cisco. So that selling pressure is over, and we're starting to revert that. And I literally just think time will allow us to bring our debt down and to allow us to go find buyers now that the sellers are done. And I do think the share price will just revert, and we'll trade back up to their multiples.
Yeah, no, super. I'm just going to ask everyone on the call, feel free to kind of type out your questions, and I'll be happy to ask. We have no more questions in the queue, so I'll just kind of go on and ask Nolan a question myself. When you kind of talk about the portfolio, 250 mines, 40-year cash flow generating, how do you think about kind of transacting them? I mean, for example, you have debt, but you also have a lot of assets on the balance sheet, right? I mean, people that are looking at your debt are, not really paying attention to these loans that you have to the mines and these royalties that you have that are currently cash flow generating. So, I mean, you could, technically speaking, sell some assets and kind of pay down a lot of debt if you wanted to, if you had to. How do you kind of think about that scenario?
Yeah, that's actually a fantastic question. We right now are in the process of internally looking within that, not within the 40, but within the 210 things that are not producing and not cash flowing. We're actually in a process of looking through that and going, is there any logical buyers out there for anything in here that would have substantial value that we could sell for cash and pay down debt? So we're actually going through that process right now. Generally speaking, as a streaming and royalty company, as a growth company, when we buy things, we don't like to sell them. Right. But with interest rates where they are, we're giving some consideration to it. We're not seriously considering selling anything that's cash flowing at the moment, though.
Okay. And then just one more on the alignment of incentives. Now, you founded the company, you are a big shareholder. Can you talk a bit about, the ownership that the management has in the company and kind of how everybody gets compensated?
Yeah, so I'll talk mostly about me. Happy to talk more about other people in details, but so my base salary is about $400,000 US a year. I live here in Canada in a 56% marginal tax rate jurisdiction, so I take home about $180,000 a year. And all of my compensation outside of that is variable, the vast majority of which is stock-based, so either restricted share units that have invested or stock options, those types of things. But when being a founder of the company, I put my life savings into Sandstorm at the time, and so I have a large share position. And in fact, just in the last year, because our share price has been under pressure, I went out and borrowed. This is maybe not super wise, but I went out and borrowed $2.5 million and invested $2.5 million of my own money in buying Sandstorm shares this year. Sandstorm is now 70% of my net worth. And I was running the numbers the other day. My net worth goes up or down $3 million for every $1 change in Sandstorm share price. So if you compare that to my after-tax take home, it works out to something like a $1 change in Sandstorm share price is equal to 18 years of my after-tax base salary. So there's some CEOs out there who are running these lifestyle companies where they're like, I don't really care if the share price goes up or down. I just want to collect my salary next year. I do not care about my salary. I just want the share price to go up.
Yeah, and does this permeate through the organization?
Yeah, we have minimum share ownership rules for all of our senior management of 3 to 5 years, depending on their position. Same for the board. Our corporate development team, we tend to give them more share-based compensation because we want them to really be motivated to do smart transactions and have the value of the company go up. Our technical team, it tends to be more fixed, high salary with less incentive because and then we'll give them maybe some restricted share units, but we don't want them to be incentivized to do deals. Like, we don't want them thinking, hey, I'm going to get a bonus and stuff like that at the end of the year if we do a bunch of deals, because we don't want them to be incentivized to say yes to things just to get their bonus. We want them to be methodical and thoughtful scientifically. And if they think that something is risky, we want them to tell us, don't do it. And so we compensate them quite differently.
Okay. And I guess the last question from my perspective, on your shareholders, on your board, I mean, can you just talk a little bit about if everybody's supportive, if just your kind of your bigger shareholders, what mandate kind of have they given you, and kind of what do they like to see the company in 5 years or 10 years?
Yeah, we've got a great board. We just added a new board member, Ila Flavesque, at our last AGM. She used to be the CFO of Cisco Gold Royalties, one of our competitors. So brings a lot of useful and thoughtful insight there. The board gets along very, very well. Shareholders are so very supportive of the board. I think at our last AGM, shareholders voted 99.3% in favor of me, and very high for everybody else as well. So it's everybody's on the same page, and shareholders are supporting the board.
Okay, no, super. Unless there are any other questions from the audience, that's all from my perspective.